Hello, welcome to the ISDA AGM studio. I'm here with Jack Hattem, Managing Director in the Global Fixed Income Division at BlackRock, and Sonali Das Theisen, Global Head of FICC E-Trading and Market Strategic Investments at Bank of America. Sonali, Jack, thanks for joining us.
Thank you.
Now, we've seen a bit of a perfect storm in markets in recent times. We've seen rising interest rates, liquidity crunches, geopolitical events, and of course, the recent turmoil in the US banking market. I wanted to get your thoughts on how that's affecting trading and hedging strategies. And Jack, perhaps I can ask you first.
Sure. Thanks, Nick. Thanks for having us. I think in this current environment, just having good, sound risk management is as important as ever. Really understanding your risks, understanding how those risks evolve when there are volatility shocks or correlation shocks. And I think at the same time, what we're trying to do is achieve results for our investors and our clients. It's all about delivering solutions for them. So in this type of storm of volatility, it's relying on the collaboration of our teams to really analyze the opportunity set with all of these dislocations happening.
And Sonali, can I get your thoughts on that?
Sure. So I think that all the tools are being pulled out of the toolkit. I think the markets have actually been surprisingly resilient. In terms of liquidity, while depth in the market may have been, impacted, certainly in short end of rates, et cetera, the actual bid offer widths, et cetera, have been remarkably resilient. And clients have also adapted to, trading in smaller sizes, et cetera, where it's been needed. I think, focus on data and making, decisions with data has become, even more and more important these days, as well as just sort of the risk recycle through the ecosystem, right? Like how do we spend a lot of time on how do we do that better? How do we centralize risk within each of our asset classes, et cetera? So I think the ways that the toolkits are changing, there's just more products, more availability of data, and I think we're all weathering the storm fairly well.
Great. Jack, to what extent has the recent turmoil highlighted the importance of derivatives to hedge interest rate risk and counterparty risk?
Sure. Well, as Sonali said, it's all about really exploring all the tools in the toolkit and realizing that toolkit changes and evolves and grows. So, when thinking about how to use those tools, I think first there needs to be a really good understanding of the objective you're trying to achieve. Break down your risk metrics, understanding what scenario you're trying to hedge and what risk metric you're trying to hedge, and then realize that you could have the right tool for that right purpose. And I think when putting those two together, you'll find that the usage of derivatives is likely to grow as people, really identify the right ways to appropriately manage their risk.
Great. And Sonali, one final question for you. What's the outlook for the remainder of 2023?
Well, I think this environment rewards, those that can be prepared for, global cross-asset solutions. That's certainly where the work of ISDA has been, tremendously helpful. That's where, institutions like ours, we're prepared to provide liquidity in any derivatives or cash product across the globe. So I think that, we expect to see continued volatility, whether it's, around, looming debt ceiling, just as we move from thinking about inflation to growth and what the recession cycle may look like, timing, et cetera, to geopolitical risks. Right, we know that there's so many things that are going to be out there. The market is awake and thinking about all of these things. It's a question of what it's pricing on any given day. But I think we need to be prepared for all scenarios.
Fantastic. Thanks very much for joining me, and thanks a lot for speaking at the AGM this year.
Thank you.
Thank you.